Today, I want to challenge one of the biggest myths in investing. Most people believe successful investing is about finding the perfect stock. Benjamin Graham believed something entirely different. He believed your greatest enemy isn't the market. It's the person staring back at you in the mirror. Think about it. Imagine walking into a store and seeing your favorite phone discounted by 50%. You'd probably be excited. Yet, when the stock market offers the same kind of discount on a great business, people panic. They sell. They run. Why? Because our brains aren't wired to separate price from value. This is the psychology behind value investing, and it's why Benjamin Graham's lessons remain as powerful today as they were decades ago. Graham introduced one of the most influential ideas in investing: intrinsic value. Every business has a real worth based on its earnings, assets, and future potential. The market price, however, is driven by emotions: fear, excitement, greed, and uncertainty. Those two numbers are often very different. The challenge isn't learning to calculate value. The challenge is trusting your analysis when everyone around you disagrees. This is where herd mentality quietly destroys wealth. Human beings evolved to survive in groups. Following the crowd once kept us alive. But in the stock market, following the crowd often means buying when prices are already inflated and selling when fear has pushed prices far below their true worth. Graham captured this beautifully through his famous concept of Mr. Market. Imagine a business partner who knocks on your door every day, offering to buy your share or sell you his. Some days he's wildly optimistic and demands a ridiculous price. Other days he's depressed and offers you an incredible bargain. His mood changes constantly, but the value of the business doesn't change nearly as much. Your job isn't to agree with him. Your job is to decide whether today's offer benefits you. That's easier said than done because of loss aversion. Psychologists have found that people feel the pain of losing money much more intensely than the pleasure of gaining it. This emotional imbalance causes investors to abandon carefully planned strategies the moment markets become uncomfortable. Value investing demands something increasingly rare: patience. Not passive waiting, but disciplined waiting. It means understanding that time is often the greatest ally of a well-chosen investment. While others chase headlines, trends, and the next hot stock, the value investor quietly searches for opportunities where price has drifted away from reality. Benjamin Graham also introduced the concept of a margin of safety. It's more than a financial principle, it's a psychological shield. Buying below intrinsic value creates room for mistakes, unexpected events, and market volatility. It reduces emotional pressure because you're not relying on perfection to succeed. The irony is that value investing often feels uncomfortable when you're doing it correctly. Buying while others are fearful can feel lonely. Holding steady during market turbulence can feel unnatural. Ignoring the excitement surrounding speculative investments can make you wonder if you're missing out. But emotional discomfort is often the price of long-term success. Perhaps that's Graham's greatest lesson. Wealth isn't built by predicting tomorrow's market movements. It's built by mastering today's emotions. In the end, the stock market is less a test of intelligence than a test of character. Knowledge helps you recognize value, but emotional discipline allows you to act on it. And when you can separate your decisions from fear, greed, and the opinions of the crowd, you've gained something far more valuable than a winning investment. You've gained control over the one factor that determines every financial decision you'll ever make: your own mind.